Welcome to Breaking News to Trading Moves. 70 to 90% of day traders lose money. That is a statistical reality documented across global markets.
Yeah, it really is a staggering number when you look at it.
Exactly. So why did regulators and the financial industry recently remove the guardrails, giving millions of novice traders unlimited, frictionless access to the markets?
Right, we are looking at the recent removal of the $25,000 pattern day trader rule, commonly known as the PDT rule, and really the reality of retail trading in a zero-commission environment.
Right, so the central question we're debating today is this. Does frictionless access to the markets empower retail participants to build wealth, or does it merely expose them to an ecosystem optimized for their failure?
And to really understand what is happening to the everyday investor, we need to connect the dots between how the market operates mechanically and, well, how human beings operate psychologically. We have academic research and new regulatory frameworks converging right now.
Right. So I take the position that removing financial barriers, like that $25,000 minimum, provides necessary market access and equal footing. Moving to a system that calculates risk dynamically, rather than locking people out based on an arbitrary wealth threshold, well, it treats retail investors as rational actors who are fully capable of learning discipline.
Well, I completely disagree. I take the position that the current retail architecture actively exploits well-documented human behavioral biases.
Exploits them?
Yes. By combining zero-commission trading, gamified mobile apps, and unlimited day trades, the industry has really turned access into a highly efficient mechanism for transferring wealth away from retail traders. It operates less like a democratized financial system and more like a virtual casino.
Let us start with the mechanics of the access itself. For over 2 decades, the PDT rule was this strict, exclusionary threshold.
Very strict, yeah.
If you had an account with less than $25,000, you were legally restricted to making just 3 day trades within a 5-business-day period. And a day trade is simply buying and selling the same stock on the same day.
Right, it kept smaller accounts from overtrading.
But by removing that rule and transitioning to a much lower $2,000 minimum for margin accounts, the system now relies on risk-based intraday buying power. This means the broker calculates your limits based on the volatility of the specific assets you are trading, not just a flat gatekeeper number.
Sure, the barrier to entry was absolutely lowered, but the barrier to success remains as high as ever. I look at this frictionless environment and see a system engineered for rapid capital depletion.
How so? The tools are the same.
Because removing the PDT rule grants unlimited trades, but it does not alter the underlying math of the market. Empirical studies show that trading odds actually decrease with frequency. A comprehensive study out of Brazil analyzed data from the Brazilian Securities Commission.
Okay.
They tracked individuals by their taxpayer IDs from their very first day trade. And they found that the activity acts exactly like casino roulette. The more days a person trades, the lower the odds of success. Only 0.5% to 1% of traders earned more than the initial salary of a bank teller.
Okay, wait. I have to challenge that roulette analogy directly. If trading were purely a game of chance, like a roulette wheel, we wouldn't see institutional traders consistently succeeding year after year, right?
Well, institutional traders have entirely different advantages.
Sure, but isn't the retail failure rate a product of inadequate preparation rather than an unwinnable game? It is like handing the keys to a high-performance sports car to a novice driver.
That is quite the comparison.
If they crash, the car isn't the problem. The lack of driver training is. The retail trader now has the keys, but they still need to learn how to drive. They need to execute trades with conviction, manage risk parameters, and wait for A-plus setups.
Your sports car analogy assumes the road is empty and that the other drivers aren't actively trying to run you off the pavement. The environment itself is adversarial.
Adversarial?
Let us look at Taiwan, a market known for incredibly high retail participation. Researchers tracked performance and found that only 2% of day traders achieved consistent positive net returns over a 6-month period.
2% is low, yes.
And here's the crucial detail. Even the top-performing day traders who grossed profits often saw those profits entirely wiped out by transaction costs. The math works against high-frequency retail trading. You mentioned institutional traders. They aren't playing roulette because they own the casino. They have algorithmic execution and entire floors of quantitative analysts.
Hold on. We need to address that transaction cost argument. Because the Taiwan data reflects a market with structural frictions that the U.S. market has largely eliminated.
You mean the move to zero commissions?
Exactly. Historically, direct transaction costs, like a $5 to $8 commission per trade, ate into small accounts relentlessly. If you had a $500 account and paid $7 to buy and $7 to sell, you were down nearly 3% before the stock even moved.
That is true. The flat fees were a drag.
Right. A novice trader was mathematically guaranteed to lose. Zero commission trading removes that drag. It was a necessary evolution for smaller accounts to even participate.
But those trades aren't actually free, are they? We have to look at exactly how this zero commission system is funded, which brings us to payment for order flow, or PFO.
Yes, the wholesaler model.
When a retail trader presses buy on their app, the brokerage does not route that order directly to the New York Stock Exchange. They sell the right to execute that order to a wholesale market maker.
And the wholesaler fulfills the order and makes a tiny profit on the bid-ask spread.
Exactly. They pocket a fraction of a cent per share, and they pay the brokerage a fee for sending the order their way. It creates a massive conflict of interest.
I wouldn't call it a conflict of interest. The SEC's regulation best interest requires brokers to prioritize the client's execution.
On paper, yes.
The wholesalers competing for that order flow are required to provide price improvement. That means they frequently execute the retail order at a better price than the public quotes on the exchange.
A fraction of a penny in price improvement does not negate the incentive structure. Brokerages earn revenue purely based on volume. According to the Wharton Initiative on Financial Policy and Regulation, 2/3 of all PFOF revenue comes from options markets.
Options do have higher PFOF rates, yes.
Substantially larger. When retail clients trade high-risk options, broker revenue skyrockets. The Wharton researchers pointed out that wholesalers pay brokers around 20 cents for every 100 shares of stock routed. To make $5 in PFOF, a broker needs you to trade 2,500 shares. The entire business model relies on inducing high-frequency trading.
You view PFOF as a trap, but consider it a subsidy. It is akin to a free-to-use search engine. Yes, it relies on advertising revenue on the back end, but the user gets a highly valuable tool at zero direct cost.
A search engine, really?
Yes. Why does the back-end payment mechanism negate the tangible utility of free trades for the retail investor? Without PFOF, we go back to flat commissions, locking the working class out of the stock market entirely.
Because the search engine isn't subtly encouraging you to rapidly deplete your life savings. A gamified brokerage app is designed to keep you clicking buy and sell until your account balance is zero. You aren't the user in this ecosystem. Your order flow is the product being harvested.
That is a very cynical view of retail brokerages.
It is what the data shows. The North American Securities Administrators Association, NASA, conducted a thorough review of this industry. They found that the house consistently reaps PFOF revenue while the retail traders incur net losses. They documented deceptive marketing practices where firms claimed 85% success rates.
The marketing abuses identified by NASA are clear regulatory and enforcement issues. Bad actors should be fined or shut down, but bad marketing is not an indictment of the market mechanics themselves.
But the mechanics encourage the bad marketing.
Let us go back to the removal of the PDT rule and look at how it actually improves a trader's ability to survive. Under the old rules, if you were out of day trades and you bought a stock that suddenly started crashing, you were trapped.
Because if you sold it, your broker would flag you as a pattern day trader.
Exactly. And they would freeze your account from opening new positions for 90 days. So people were forced to hold the stock.
They would hold a losing position overnight just to avoid the penalty.
Right, and by holding overnight, they expose themselves to massive gap down risk. A company releases terrible earnings after the closing bell, and the stock opens 40% lower the next morning. The $25,000 rule forced a trader with a small account to take a catastrophic loss.
Just to comply with an arbitrary timeline.
Yes, Now, that same trader can simply execute a stop loss, sell the falling stock immediately, and protect their capital. The removal of this rule actively allows for better risk management.
That is a compelling mechanical argument, but it assumes the retail trader is actually trying to exit the bad trade to protect capital. Have you considered that human beings do not naturally execute optimal risk management?
In what sense?
The reason they lose is hardwired into human psychology. Terence O'Dean at the Berkeley Haas School has documented this extensively. Retail traders suffer from what behavioral economists call the disposition effect.
The disposition effect. Break that down for us.
It is the tendency of investors to sell assets that have increased in value while keeping assets that have dropped in value. Imagine a morning trader buys a tech stock. Within 20 minutes, it drops 10%. Instead of cutting their losses, they hold on to the position to manage their regret.
Right. Because as long as they don't sell, it is just a paper loss.
Exactly. The moment they click sell, it becomes a realized loss, and they have to admit they were wrong. On the flip side, if they buy a stock and it goes up 2%, they sell it immediately. They cap their upside at pennies and leave their downside completely exposed. They do not manage their risk, they manage their emotions.
The disposition effect is a known cognitive hurdle, yes. But I argue this is the initial learning curve. Traders can and do learn to set strict rules. They learn to adhere to a daily loss limit and rely on their own watch lists.
Overcoming human nature in an environment designed to exploit it is extraordinarily rare. Odean also found that overconfident investors trade more frequently purely to their own detriment. For instance, men trade 45% more actively than women.
Wow, 45%.
Yes. And consequently, the more actively they trade, the wider the margin by which they underperform a simple, passive buy and hold strategy.
The behavioral data is compelling, but isn't it overly paternalistic to assume retail participants cannot overcome these biases? We don't ban fast food because humans have a biological bias for sugar and fats.
I don't think that is the same thing at all.
Why not? If traders learn to manage their disposition effect by strictly adhering to stop losses, doesn't the deterministic behavioral argument lose its weight?
Eating a hamburger does not instantly wipe out your entire net worth in a single afternoon. We are talking about cognitive shortcuts that everyone uses because of bounded rationality. The human brain has limited processing power.
Sure, the market is overwhelming.
Right, there are thousands of stocks trading. So retail investors exhibit limited attention. They herd into attention-grabbing stocks based on high volume or news.
Let me push back on the idea that they are just blindly herding. Retail participation provides crucial liquidity to the markets.
They are providing liquidity by serving as the losing counterparty to informed institutional trades. The Berkeley research analyzed people who switched from traditional telephone-based brokerage accounts to online trading.
And what happened?
Before going online, these investors were actually beating the market. But after going online, where the friction was removed, their gross returns stayed roughly the same, while their net returns plummeted. The researchers said, quote, "Online trading is like the Old West. The slow die first."
Well, that paints all retail traders with a single monolithic brush, and I simply don't agree with that characterization. The transition to risk-based margin actually requires brokerages to monitor account health much more dynamically. If a trader is taking outsized risks, the brokerage will automatically scale back their buying power.
But the NASA report found severe record-keeping violations. Firms were caught canceling trades or reassigning them just to hide margin calls.
Let's clarify what a margin call entails here, specifically a Regulation T margin call.
Right. Regulation T dictates how much credit a broker can extend. If a customer borrows money to buy stock and the value plummets, the broker issues a margin call. It is a massive red flag that the trader is over-leveraged.
And NASA found firms were hiding these?
Yes. Customers who generated a margin call would just have their losing trades moved to a firm's error account. The infrastructure of active day trading has a documented history of prioritizing order flow revenue over customer welfare.
Okay, let us bring these arguments together. I maintain that removing arbitrary capital barriers gives retail participants the tools they need. It replaces an outdated wealth-based gatekeeping system with dynamic, risk-based margin policies. It places the responsibility on the individual to manage risk.
And I emphasize that the broader market architecture, funded by payment for order flow, combined with hardwired human psychology, means increased access overwhelmingly translates to predictable financial detriment.
We certainly find common ground in recognizing that day trading is exceptionally difficult. The vast majority of participants do lose money due to a combination of unforgiving market mechanics and emotional trading.
Absolutely, the freedom to participate is not synonymous with the probability of success. The market remains an incredibly hostile environment.
Which leaves us reflecting on the profound tension between individual liberty in financial markets and the harsh reality of behavioral economics. Listeners must evaluate their own trading habits and connect the dots between their psychology and the structural market realities we examine today.
We often want to think of a financial diagnosis as clean and binary. But the diagnostic machine in the financial world is heavily clouded by back-end incentives and human nature.
Exactly. The regulatory barrier may have been removed, but the psychological barriers are as rigid as ever.